Welcome to Money Hangout once again. Every week we talk about an investment issues, some investment issue, and help you understand uh, mutual funds and try and answer some of the questions that you may have. Uh, this is brought to you by Birla Sun Life Mutual Fund and Value Research. Today we are going to talk about something which we all talk, which we all understand. We have all been taught in our high school, uh, the compounding and how it works for your investment. Though all of us have been taught about this, we don't believe as strongly and we don't appreciate it. I thought this basic concept needs a reinforcement, and I'll explain you why. This is something which was referred by Einstein as the eighth wonder of the world, though it's still disputed that whether he said so, but undoubtedly it certainly is a mathematical wonder. And compounding at its very simple level is, you put some money, the money earns, and then subsequently that earned money also earns, so your capital keeps rising. And so I'll just, I recall a story, and in ancient times, once some king was very impressed was with the inventor of the chessboard, and he wanted to reward the inventor. And he came with a very simple demand of the prize, that the chessboard inventor wanted, that he wanted one grain in the chessboard of each box and wanted it to be doubled in the subsequent one. And by the time it became, you reached to the 64th box of the chessboard, it turned out to be so massive a amount of rice grain needed to fulfill this demand. That is the power of compounding. That in effect was 2 to the power of 64. And that amount of rice grain needed was not there in the kingdom, was not there in the granary. So that is the magic of compounding. How you can do it with your money, compounding it 6 times, doubling it 64 times. That actually made that does the magic. And so that can be replicated. I think, investors' appreciation of the magic of compounding can be a big differentiator. Uh, at the very basic level, as I said, that compounding is that you put your money to work, that money earns, and then the earned money also earns. So this is a simple concept. Let me cite you with an example. You invest a lakh of rupees in any investment, and that earns 10%. So that 10% earning becomes 1,10,000. Subsequently, for 25 years, if that money remains invested and it compounds at 10%, then the money becomes, your earning at the end of 25 years is 1 lakh rupees, or because your rising capital grows to that extent. And this is compounding at 10%. Many investments in the past have, compounded at a much faster rate. There are some investment, if you don't take much, if you would not have taken much risk, maybe you would have earned 10% as well. And so 1 lakh rupee invested 25 years ago, earning 10%, will earn 1 lakh rupees every year in from 25th year. So this is the magic of compounding. Then comes, you need time to compound, and appreciating time and letting your investments compound over time. This is something which most investors don't allow their investments. They invest and they are eyeing the investment, that maybe it has gone down, by our own experiences drive us to pull that money out, or maybe there is a real need for that money, so that we don't let it grow over time. But deciding your priority, just taking money out just because it has pulling your money out just because it has grown may not be a great idea. Let me explain how time works for your investments. Uh, if you would have invested 10 lakh rupees, and if it compounds at 12.5%, which means it will double every 5 years. So 10 lakh rupees becoming 20 lakh in 5 years' time, and then another 40 lakh rupees in in 5 years' time, then another 40 lakh rupees in 10 years' time, then 80 lakh rupees in 15 years' time, and then it becomes 1.6 crore in 20 years' time. Now this 15 year to 20 year, 80 lakh will look very small as compared to 1.6 crore. So this is the magic. For 15 years, it has taken you so long to accumulate to 80 lakh. But 80 lakh to 1.6 crore takes just another 5 years. So this is where, when you allow your investment some time, then the magic gets triggered. So time and patience could be one of the biggest determinant of the rewards that you reap from your investments. Now, this works very nicely. It is well appreciated. Everybody understands the compounding or the compound interest on their fixed income. But most investors are still confused. They are doubtful about this, that how does it work in equity? Equity is because equities don't deliver you any kind of guaranteed return. When you make a bank deposit, when you deposit your money in a bank, then you are assured that you'll earn 7%, 7.25%. Earlier, you used to get 9%, 10%. Senior citizen savings scheme will earn you 9%. So your money compounds at a predictable rate. Here, there is no predictability. Some year you get, but over a period of time, we have seen that even our lame Sensex earns 18-19%. It's an unmanaged index. That's why I'm referring it as lame. And many of the managed funds, well-managed funds, have been able to give you upwards of 20% annualized return over a long period of time. 10-year, 15-year, 20-year, you earn very high rate of return from your equity investment. The only problem is that how does it compound when it doesn't promise you a return? The real reason why it compounds faster is equities tend to give, by its very design, any owner will earn more return on his capital, then only he will borrow money. And the other reason why equity does better is that it gets adjusted with inflation. All the goods and services produced by companies, their inputs as well as the output gets revised. The price of it gets revised with inflation. So you earn faster. You are generally assured that your any product or services will get adjusted for inflation, and then they can have. And then some companies do much better because they are able to drive greater efficiency, or they are able to command premium on their products. So over a period of time, equities generate higher return than fixed income. They compound faster. The only problem is that they do not give you predictable return. They do not give you, instead of 9%, 18% every year. But on a 10-year basis, on a 15-year basis, on a 20-year basis, we have seen that even a not so well picked but a reasonably diversified portfolio like Sensex or a mid-cap index or a Nifty has been able to generate substantially higher return than fixed income. And because it comes in an inconsistent way, so some years you get 5%, some year you get some negative return, but then some year you actually double your money in just a year's time. Even in last 1.5 year, we have seen that most funds are up anywhere between 20 to 40%. This 20 to 40% range actually makes the compounding inconsistent, but over a period of time it has been higher. So compounding at a higher rate and letting your investment be there for a long period of time is the simplest secret of really growing wealthy with your investments. Don't undermine this simple concept. Most people will think that what is big deal about it? Everybody knew it. But I think doing it actually makes it all the, brings about all the difference. You have to do it. We don't do it. I was just looking at, one of the mutual funds, and I did a simple SIP assumption of 1.5 lakh rupees invested in one of the fund, which was compounding at rate of 25%, and doing a SIP. Mind you, this is not compounding of a initial investment over the last 25 years. Doing a 1,50,000 rupee in annual investment over the past 20 years in something which is compounding at 25% annualized becomes 6 crore rupee, which means 1.5 lakh rupee invested every year for the last 20 years, where your capital will be 30 lakh rupees. That grew to 6.5 crore rupee over the last 20 years. So this is the magic of compounding. Start believing in this, start appreciating this power, and look forward to such return. I don't know whether it will be 25% less or more, but it will be substantially higher than you can think of if you are able to inculcate the habit of remaining there, appreciating the erratic nature of it, and allow your investments time to benefit from this. So I hope that you I am able to contribute something to your thought and reinforce the idea of compounding to benefit from it.
Thank you, Dhiren. We'll
Thank you.
now move to the question and answers. Amit asks, what is the relationship between compounding and inflation?
Compounding and inflation, the connection is that normally interest rates are pegged at inflation. So depending on the inflation rate, because the whole idea of interest rate is that you should be able to earn some positive return. So if inflation rates go down substantially, inflation goes down substantially, interest rates will come down, because even a small, assuming in the United States of America, we have seen that interest rates are very low. So even 2-3% return looks very decent, and that also translates into a higher rate of return, positive return for investors. In India, the inflation has been high. So even though we see that high interest rate, 8-9% return, which we earn on our deposits, even now we are able to earn 8.25 or 8.5% on some of the sovereign guaranteed savings avenue for the senior citizens. It looks very high, but it's not very high because our inflation is high. So our net, our post-inflation, inflation-adjusted return is far lower. So if interest rates come down, so I think inflation is the reference for the returns that will be generated in the economy. So if inflation, and then equity premium, what is being referred as what we earn on our risk capital, is a function of what is the prevailing risk-free return. So if inflation is 5% and if our fixed income return is 8%, then I would expect a higher return from equity. So inflation is the basis of the returns that we tend to expect, and the system justifies the return on those capital. So in future, if if inflation is going to be very low, interest rates will come down. Interest rates will come down, equity returns will also come down. But we will still be better off, because it is the differential which matters, that are we able to beat inflation by a wide margin. And if we are able to, even though the absolute returns might be lower, we will still be much better off.
And I think beating inflation is very pertinent because, like compounding has a brilliant effect on our returns, but it can similarly have a devastating effect with inflation, isn't it?
Yeah, absolutely. If you have this investment, and assuming that we are compounding at 10%, but inflation is at 12%, then all your compounding goes waste, because by the time you accumulate if the way your money accumulates, and effectively the terminal value of your investment will be such that it will not be able to buy, it will lose its purchasing power. So loss of purchasing power is negative return. If you could buy something worth, if you can buy something for a lakh of rupees today, and if you have after 5 years 2 lakh rupees, but you can't buy that thing for 2 lakh rupees, which means even though your money has grown, but it has lost its purchasing power.
Moving on, Dinesh asks if the power of compounding also works for PPF and Sukanya Samriddhi Yojna.
Yes, absolutely. You are actually compounding your investments in these two plans at a fairly predictable rate and in a guaranteed way. And you also get some incentive in terms of tax break under Section 80C. But then what you are getting is little more than inflation. And given the nature of these investments, that they are 15-year term recurring deposits, I would urge that this is the kind of time frame when you should assume the equity risk. Equity looks risky in the short run. Equity becomes is virtually risk free when you are making regular investments over a 15-year time period. So effectively, by choosing these two, Sukanya Samriddhi Yojna or PPF, you are compounding your you are compounding your long-term money at a far lower rate by not assuming the risk of equity. And it is not a risk assumption, because if you are disciplined with equity over a 15-year time period, I would say that it is absolutely a no-brainer that you will beat the fixed income by a very wide margin without much of a risk.
Moving to the next question, quoting John Bogle, Arvind says that the miracle of compounding of returns is overcome by the tyranny of compounding of costs. He asks how this tyranny can be managed in SIPs over the long term.
No, you can't really. It's not a matter of tyranny of cost, because if you don't have the money, how do you put it to work? And the fact is that in all our lives, in our accumulation phase, we are working to earn, and then when we earn, we save a small, we put to work, we invest a small part of it. So if that is the case, this is a tyranny, but you don't have a choice around it. You don't have a choice. You have to live with within your means. You have to spend money to make a living, to take care of the essentials. So I think this is a philosophical question. Ideally, everybody should have had all the money 20 years back, but hindsight is always perfect. I think we should be more realistic with our configuration, our life configuration, which is that we work for many years, we save a part of our income, and we put it to work. Put to work as much as you can in your early phase, so that a good part of your investment, or whatever be part of your investment, is at work for a longer period of time. I think time is crucial. So having this belief, and having the deep belief in the power of compounding, and giving it the time when it works, when it does the magic, is very important. Don't get into yeah, don't get, we can't do much about it. So go on with your necessities.
On a related note to SIPs, Dheeraj asks how can we measure the compounding effect in case of SIPs?
Oh, just set up your portfolio at Value Research Online, and what we give you is the internal rate of return for the cash flows. Because computing your compound interest is very simple when you invest lump sum. If you invest 1 lakh rupees, and if that becomes 5 lakh rupees in 20 years' time, you can just put the formula of compound interest. The compound interest calculation for your periodic investment becomes complex, because if you are doing a 10,000 rupee SIP, and you take a look at the return 5 years from now, your 10,000 rupee was at work for five years. Your next 10,000 rupee was at work for 4 years, 11 months, so on and so forth. Your last installment of 10,000 rupee was at work for only 1 month. So you have to compute interest, you have to compute the worth of all these investments, and then do a internal rate of return, that aggregate basis, assuming this was your deposit, and based on the sum total of the terminal value, what it translates into. So Value Research Portfolio Tracker gives you this return on the dashboard of your portfolio tracker. Once you put all your transactions, you can also automate your transaction. You can upload your account statement, and all these transactions will be absorbed, and you don't have to really type in all the transactions. You can also set up your SIP. It requires 2-3 fields, that you have decided to invest this much rupee in this fund starting from this date, and you will be doing it for 60 months, 120 months, or for perpetuity, and at what periodicity you will be doing it. And Value Research Online, the portfolio manager, takes care of it.
Moving to a very different topic, Dhiren, Pradeep asks why mutual funds purchased before 2013 without using the services of a distributor are mapped to a regular plan instead of a direct plan.
Because that was the law. Before 2013, there was no differential pricing. The direct plans were not there, and even subsequent. So if you made direct investments prior to January 2013, your pricing was the same. The regular plans and the regular investors, or the direct investors, even if you did not go through a distributor, got the same NAV. And after the direct plans were launched, those direct investors had no choice, because if you wanted to benefit from the direct plan, you had to redeem your investments and put the new money, because the pricing was different, the NAV was different. So if you haven't done that, do it. And it did not happen automatically. It could not have been done automatically, because the regulators did not permit that, because that would have amounted to redeeming your investment and making a fresh investment, and that could have triggered some tax implications as well, if your investment was less than 1 year old, or and so forth. So all older investments, the status quo was maintained. So But if you would have moved your money to a direct plan from a regular plan, you would have earned little more.
Antara asks if growth option or dividend reinvestment option is better for equity and equity oriented hybrids.
It is not a matter of better option or worse option, because you earn exactly as much return in the dividend option or the dividend reinvestment option or the growth option. The only issue is that when you choose the dividend option, you opt to take a part of your gains periodically. If you choose the dividend reinvestment option and the growth option, there is absolutely no difference. You will be given the dividend, but instead of being given in the form of a of a cash dividend, you will be allotted more units. So if you choose the dividend reinvestment option, if you invest a lakh of rupees in dividend reinvestment option and another lakh of rupees in the growth option, the sum total of the worth of your investment will be the same. I would say that when investing in equity, when making a growth investment, your idea is not to derive periodic income. So one should, to keep it simple, to keep the accounting simple, choose the growth option.
Next up, Deepak says that he wants to invest 1,50,000 every year in ELSS to derive the benefit of Section 80C and rotate it after every three after the lock-in of 3 years period is over. Is that a sound strategy?
Uh, if you are really in difficulty, if you are with great difficulty able to save 1.5 lakh rupees to save tax, then it might be a sensible strategy, because saving tax is important on your income. But looking at it in a very simple manner, that this is your opportunity. If you are disciplined, and as I was saying in the earlier part, that in one of the fund in which somebody would have invested in a tax saving fund 1.5 lakh rupees every year for the last 20 years, which has compounded at 25% annually, your 30 lakh rupees investment becomes 6.5 crore rupee. Why do you want to miss on this? Your tax saving investment of 1.5 lakh rupees can well translate into your retirement corpus or something very sizable. Even if it does not compound at 25%, if it compounds at 18%, 17%, or 1.5 times, twice as much as the fixed income, I think it will you need to really give time to your investment. By virtue, by stopping your investments after 3 years, if you can really continue to invest, by all means do that. Continue investing. If for some reason the investment that you have made in the past 3 years, you get suspicious of that, the investment quality doesn't look that impressive, or things have changed for the worse, or the fund manager has changed, or something like that, then by all means change that investment. You will be at liberty to move your money around, move your money to any equity fund after the lock-in period. But I would say that discipline over a period of time and regular investment over a long period of time is all that most investors need, and it can do magic.
Moving on, Gagan says he has 50 lakh rupees to invest for the next 12 to 15 years. He asks what should be the duration over which he invests this money systematically.
Uh, Sorry, I just missed the last part of the question. For what time period? Ashit, can you repeat the question, please?
Sure. So this gentleman wants to invest 50 lakh rupees and this is a long-term corpus. Now he wants to know what should be the duration over which he spreads his period of investment.
Okay. Generally, there is no thumb rule, but I would say that it is very important to stagger your investment whenever you are making a large lump sum investment. But this large is also a very relative thing. If this 50 lakh rupees is something which you earn every now and then it is not large. If this is something which you are unlikely to earn in your lifetime and it is a very sizable thing, if it is your retirement corpus or something which you are looking forward to, you are unlikely to get such an opportunity. I would say that if this is that crucial, that money, I would like you to spread it over at least 3 year period. If this is something which is of a routine kind, if this 50 lakh rupees is something which you earn every 2 3 years anyway, by virtue of whatever profession or business or activity you are in, then maybe spread it over 6 months to 1 year period. But if this is a very important money, it has taken many years for you to accumulate, maybe a decade or two, then definitely spread it over a 3-year period, simply because you will be able to catch a good part of a market cycle, and eliminating the possibility of catching a market high is very crucial when you are investing a large sum of money.
Next up, Ganesh says that he read a recent article which suggested that he should not invest in capital gains bonds for saving taxes,
Yeah.
but invest in equity instead after paying taxes. He wants to know what's your take on this.
No, my take is that capital gains bonds strike a chord with most investors simply because we are averse to paying taxes. But compounding at a higher rate require you earn 5.25% in the capital gains bond, and you are exempt from the taxes. You are able to save on the taxes. I would say that if you lose 20% of your capital after indexation and put 80% to work, and during this period if you are able to generate 12%, 13%, and that too in a tax efficient in a tax free manner, because all the returns on equity is tax free. So compounding at a higher rate, saving on that 5-year period, and getting all the returns in the form of which is completely tax free, I would say that you are well on your, and if there is no need for you to deploy that asset, that money into another capital asset. If you are substituting an asset, then by all means you should. But I would say that if this is your long-term your realization from an asset, keeping it in financial assets, compounding it at a higher pace, higher rate, even after paying the taxes, is worthwhile.
Next up, Mr. Roth asks how can he switch from a regular plan to a direct plan in an ELSS within the lock in period?
You can't do that because within the lock-in period, there is absolutely no way you can move your money from the regular plan to the, or no transaction can happen. Only in one situation it can happen, and of course there is a legal provision to do it, but it is practically not possible. So only in case of death of the holder that the money can be realized. Otherwise, it is not possible. And even after you are through with the lock-in period, the only way to do it is redeem and invest again. Then why should you do that? Once you are out of the lock-in, maybe you will have all the choices to make from the universe of equity fund. Why get into a lock-in again?
Our next question comes from Karthik, who is 20 years old and says that he wants to make the most out of compound interest and has a 40-year horizon. He asks if you could tell him how he can do this.
You have 40 years. I would say that it is very important to develop a belief in this. Uh, this requires patience, this requires great belief, and compounding will happen automatically. All you have to do is choose one or two funds. Start from something which will not scare you and be at it for 2 3 years. You will understand, you will develop a belief. If you have already experienced it, then maybe get started from an all equity fund, and take a vow that you will not pull your money out whatever be the state of market, and you will continue to invest your small amounts over over any calamity. In the worst of times, you will continue doing it, because my belief is that in a 40-year time period, one will definitely get 2 3 large market cycles, and 2 3 large market cycles will compound your money dramatically. And if you continue to do this with great discipline, and you don't get impatient, you don't get perturbed, you don't get nervous, you don't get scared, and there will be scary times, there will be difficult times. There was a time in 2008 when it looked as if the world was coming to an end. The financial markets were crumbling, they were crumbling world over. Nothing was working, fixed income was collapsing, equity was collapsing, large investment banks were collapsing, and all over the globe there was no island of prosperity or safety. So there are, and I think in next 40 years we will get couple of such occasions, and sticking through that period belief in that, and being able to hold, sit tight through this time period is all there to it. And once you have done it for 4, 5, 7 years, I think it only gets easier. Your belief gets reinforced further. So you don't need me. You just need to be stronger about your convictions and belief and be disciplined.
We'll take one last question for today's
Sure.
session, Dhiren. Sankar Dayal asks if it is safe to invest in small cap funds if he has to redeem in 2 to 4 years.
Not at all. In fact, most investors are getting attracted to small cap fund. I would say that small cap fund, if you look at some of the worst time period in 2 to 3 years, you could have made money. But there is a possibility that you will end up not making money at all in 3, 4 years time, because there is, generally the cyclicality in every segment of the market, including small caps. Small companies have done very well in the last 2, 3 years, and there is a possibility that they will revert to mean. They will not generate any substantial return. Many investors are getting attracted to them because they have done well in the past, and some of these will correct, will drift, will not generate return. So it is not a good idea. For 3 to 5 years time frame, I would say that even if you are willing to assume, ideally one should not be investing in any growth asset for this time period, but assuming that you are willing to take some risk and invest in a balanced fund or invest in an equity income fund, which will be even more conservative, you are likely to beat fixed income return by a modest margin, and that should be your expectation.
Thanks, Dhiren. Any
Thank you.
parting advice for our viewers today?
Yes, believe in compounding. This is the simplest magic that is needed for your investments, and it looks too simple a concept, but it is so powerful that if you are able to compound even at a lower rate over a long period of time, so you need time and you need compounding at a reasonable rate, and if possibly with a higher rate, then the magic will happen. Don't expect any real magic. This is a fairly predictable magic which you should trust.
Thank you, Dhiren.
Thank you.
Thanks everyone for joining in. We look forward to your presence next week as well.